We're recording.
All right, sir. And ladies and gentlemen, I guess what we'll do then is call to order the meeting of the Board of Trustees of the City of Palatka General Employees Retirement Plan. We have a quorum present. We have.
Take roll call.
Yeah, please.
Yes. Alan Bush,
Yeah.
Don Holmes,
Yes.
Tammy McCaskill,
Here.
Brett Dennis.
Wait, she's not here.
Yeah. Okay. So we have a quorum. Jonathan Griffiths, I know he's absent.
Vacation.
He might be joining in on, watching on YouTube, but
Okay, we got ratified.
yep.
Yes.
Yes, he just, yeah, he took a vacancy, I think in January, February.
I think I'll play that.
I'm in the meeting. Okay,
With that, I see the city attorney, Ms. Thomas, is present. She's city attorney when I let her be. Don't go ahead.
Yes, sir, I'm present.
Better be quick on that unmute button, Attorney Thomas. You know
Yes,
how-
sir. Yes, sir.
You know how I'm prone to offer opinions on your behalf.
Yes, sir. I do know that.
Okay, so we had roll call. First order of business would be the approval of the minutes from the prior meeting. Has everyone had an opportunity to review them?
Yes, motion to accept minutes is written.
A motion by Commissioner McCaskill. Second. Second, Al. By Mr. Bush. Any discussion? All in favor? Any opposed? All right. PC report.
Miss Joe, we can't hear anything.
Can't hear anything. All right.
Can you hear me now?
yes,
Okay, my
Yes,
mic
thank
wasn't.
you.
Yes, we can hear you.
Okay, so Patrick, I think you're up next. Foster and Foster, the experience study progress.
yeah, we proposed experience studies for all three plans and the other two hadn't acted yet. We have completed your experience study, but my vision was to present it in September. But if Jill lets me share the screen, I can give you guys a sneak peek if you want.
Okay,
Can I share my screen?
Yes, please.
Okay. Oh, it says I can't while another participant is sharing.
the wonders of Zoom.
It has the agenda up there. There we go. All right, can you guys see? Can you guys see the summary there?
We can see, we can't read it.
We had to strain pretty good. Can you enlarge it at all?
Yeah, I can do that. Let's see here.
Won't you be glad when we can stop doing Zooms?
Okay, much better.
So I skipped right to the end. I was looking at the report while you guys were talking. And, this hasn't been peer reviewed yet, but, I'm sure it should be good. But what you can see here is, we look at all of your assumptions, investment returns, salary increases, turnover, retirement rates. And then we recommend changes and we show what that would do to the funding. And the good news here is that, the investment return, obviously, if you lower the investment return assumption, if we think we're going to earn less in the future, then we're going to have to put in more contributions. And so if we change from our current 7.5 down to 7.25, well, that's going to increase your funding requirements by 2.1% of payroll. If we lower it to 7%, that's what FRS is right now. That would be 4.4% of payroll. I know Burgess is in the room and he may think, you know, there's no rush to lower that assumption, but this is just showing you if you did lower the assumption, this would be the impact. But your other assumptions, looks like if we change any of those, that would actually help the funding requirements. Salary increases, retirement rates, and withdrawal rates. So first I'll go to salary rates. So right now, our assumption is over here based on your service. Salary increases are usually bigger at the beginning, partly because of the way the city reports pay to us when someone starts. But then I think you also have steps and all that in the beginning. So our assumption right now is 8% the first year and then 5% every year thereafter. And then the actual experience over the last 10 years has been this: 10.7% that first year, 11% the second year, and then it's been pretty stable, 5.8, 5.6, 5.4. But over 5 years of service, the average has been 4.6%. So your assumption is not really out of line right now. But since we're doing the study, we might as well tweak it. And so we'll go to 10% for the first 2 years, 5.5 for the next 3 years, and then 4.75 for anything over 5. And since a lot of your time here is over 5 years of service, that'll actually reduce the funding requirements slightly by 0.4% of payroll and reduce your unfunded very slightly. So again, your current assumption isn't bad, but we could tweak it a little bit and that would help the funding requirements. Is there
Patrick, I don't know if it's
questions
appropriate to
about the
mention.
salary assumption?
Yeah, could I speak? Can you hear me?
Sure.
I don't know if it's appropriate right now, but I think it's relevant to note that we are about to do a salary survey because we're finding in the job market that we're seem to be at a competitive disadvantage with our salaries. So I just, as a matter of fact, was provided the responses to an RFP that we or RFQ that we issued a couple of weeks ago. And with the commission's approval, we're going to be sanctioning a salary study and a personnel manual revision. And the commission has expressed its intent to raise salaries. So by how much and you know, what the overall impact or amount will be, I cannot say. But I guess I lost one screen. But that will be on the table before our next meeting in September.
Well, so what we can do, remember I said this is just a preview. So
Yep.
when I talk to you guys in September or come there, we'll have more information on that salary. So we
Right.
can decide if we want to tweak that assumption further.
Great.
If you guys are going to set up new step programs or something, then we might want to change the structure. I probably wouldn't do much if you're going to do a one-time adjustment. Because
I would imagine, or I should say that it's my hope that we're going to do more than a one-time adjustment. I think that our rate structure is antiquated and not really very efficient. And so I haven't even looked at the responses, but I believe that we're probably going to be looking at a little bit larger revision, a little bit broader scale revision than just a one-time adjustment. That's my
Right.
belief.
that sounds good, and we'll have that information. So then the other two assumptions are retirement and turnover, the other two major assumptions. So retirement, you know, if somebody works till 70, they get a different benefit than if they work till 60. And so we have to make an assumption of when people are going to retire. And you can see here, our current assumption is here, 10% are going to retire from 50 to 54. That's 10% each year they're eligible for retirement. And then 25% at 55, then 20, 40, et cetera. And then you can see again, your assumption is not too bad right now, but we might as well tweak it to be even more accurate. So the proposal is over here, like 50 to 54-year-olds have been retiring at 14.4%, and our current assumption is 10, so we're proposing to make it 15%. And so if we make those changes, that actually reduces the funding requirements. And then withdrawal rates is people that terminate before retirement. And again, your assumption isn't too bad because your overall actual rate has been 14.1% per year over the last 10 years. And our assumption currently would have been 13.8%. So again, it's not too far off, but we propose tweaking it to be more in line with your actual experience, like less than 1 year. In that first year, you have higher turnover than our current expectation. So our proposal would be to go to 20% expected turnover in that first year. So those were kind of the highlights, but we'll go over it again in September.
Very good, thank you. Anything further from you, Patrick?
Nope, unless anybody has any questions.
Any questions from the board?
Actually, do you guys need me for anything else in the meeting? I mean, I'd be happy to stay on, but I didn't know if there's anything else.
Anything from you, Mr. Bush? You anticipate needing him further? Do you anticipate needing Patrick further during this meeting?
No, I just wondered who all going to be included in this adjustment if they do it.
Well, I assume that the rate structure would apply to all employees. I would assume that the revisions, because what we have asked for is essentially a model for us to work with that would include step in pay advances based upon performance evaluations and things of that nature, which, right.
What about retired? The reason I'm asking, not for myself, but I had a couple of people bumming about future inflation.
But that I don't believe that's part of the rate structure that I don't believe it is. I mean, I
I
don't think
can
that's.
hear Mr. Bush when he's talking.
Yeah, Mr. Chair, we can't hear his question.
Press your button, Mr. Bush. There you go. Now repeat what you said.
We still can't hear him.
I'm sorry.
Go ahead and
Now
speak.
can you-
Yeah, are you there? I've had a couple of people that are retired that have asked me about this. They're concerned that maybe inflation is going to heat up, given what's happening out there, all the money that's being printed. They'd like to know if it does, are you all going to address the retirees also?
Well, that would be something, for the board and the city to consider. Giving like cost of living adjustments for the current retirees. I can do a study that would show how much that would impact the funding requirements. But usually that kind of a decision is made by either the board recommending to the city or else the city just deciding on their own to do that type of adjustment.
And if you did that study, Patrick, that would be in excess cost of what we're currently paying you the 7,500, right?
That would be an addition.
Right, that's a different type of study than the one that you're looking at now.
Okay.
It wouldn't be $7,500 because it's not nearly as involved as this experience study. We would just say, okay, let's give the retirees an increase, maybe based on how long they've been retired. That's the way a lot of cities do it. If you've been retired 2 years, you get a 1% increase. If you've been retired 10 years, you get a 5% increase or something like that. That's usually the type of study, you know, if there's cost of living inflation, then the city would consider doing that.
Can we consider getting a quote on that just to see? I mean, because.
I would like to see us, y'all to include that in the study and come back with some dollar figures that we can examine. You don't have to,
Again, it will be a separate study from the experience study because it's.
Yeah.
But if we can get some numbers on that, I mean, I don't think it'll hurt because we do need to consider those folk that are already retired. And we have had conversation about this in the past in previous meetings. So if you can come back with a number.
Yeah, well, what I could do is maybe I'll do, because our minimum fee is $1,000, but I could do a couple of scenarios for that. So I could do one based on how long you've been retired, and then maybe one that's just a flat, everybody gets one increase. I could do a couple different scenarios for you. Would you guys like me to do that for the September meeting?
that would be good.
I
And
would like
also
that.
the amount of increase that you would give. I realize that in Palatka, it had to be very minimal amount, but it'd be nice for us to look at.
Well, and the nice thing about a cost of living, an ad hoc, a one-time cost of living study like this is that if I give you the numbers for a 1% increase, the numbers for a 2% increase is just twice as much. So that lets you can extrapolate the study that I do to, you know, decide if you want to do a different amount.
Okay.
Sounds good.
But since it is a cost, I think the board should make a motion to approve that study.
Okay, with that being said, I motion for you to give Patrick, the go ahead to conduct that study.
And I would second that.
Any further discussion? All in favor?
Uh,
Okay, I think you have a adopted motion.
All right, well, thank you, guys. And you guys have a good day. And if you need anything, Burgess can text me and I'll hop back on.
Okay, thank you. All right, sir. Mr. Chambers, I think you are up next.
Thank you. Great to be here. You have a report? So here's my marching orders after the last meeting. They were first to review the SunTrust custody agreement to see if there was any room to negotiate a better fee. What we discovered was back in 2011, the fee structure was lowered from 12 basis points to 5 basis points. And it's our opinion that the current structure is competitive. So there really isn't much to do there with respect to SunTrust. On page 4, you can see a table. What we did was we took the 6 products that were where we could migrate into a lower fee structure, share class structure. And we went ahead and did that. And so, for example, Vanguard Russell 2000 growth fee structure went from 15 basis points to 5, 40 to 20, 49 to 13, and so on. So these will be significant enough to lower the overall expense ratio down closer to 40 basis points overall. So that's been completed. We talk about asset allocation all the time. And I think in the past, we've compared this plan to the police and fire. And to help you kind of understand this, if you go to page 12, the overall asset the different asset classes are depicted here. Domestic equity, that's considered equity. Infrastructure is equity. Convertibles are considered equity, and so forth. The only non-equities that are in this program are fixed income and cash. Your program has a 60% weight to equity classes. And you can see 39 and 1 equals 40. There's a complement to that. The other 40% is in bonds and cash. The police and fire plans have 65 in equity. And it's all domestic. The increase is domestic. So while you're at 27, they're at 32. So there's the difference between this program and the police and fire, is that you have a 5% lower allocation to domestic equity. You're 27 versus their 32. The other thing that happened last meeting was I said, look, let me let the equity allocation move upwards. Let's let it float up. And so when this report was published, your actual equity allocation was 65.3. And that's the target of the police and fire. Now, while I say that, the police and fire have their actual target, while it's 65, they're running closer to 70. So they're within the range, but they're still about 5 percentage points above you. Now, if you want this program to run a little faster, I mean, if you go to page 21, if you want to bump this program up to be more like the police and fire, that I would suggest moving it up to 65% target. You're at 60. If you look at these symbols here, your strategic model is the intersection of those crosshairs. And the risk on, or the equity assets, are in the northeast quadrant, the bonds are in the southwest quadrant. To go to 65, you simply would be rolling that symbol, which is right in the center of the crosshairs. You'd be rolling it up that 45-degree line, essentially pushing your expected return higher and pushing the associated volatility higher. That's what would occur if we did that. This is something we can easily do for you. We can take your existing policy and dial it up another 5%.
Okay, so can I ask a question?
Yes, sir.
You said that that we had, and I looked at the minutes to see how the minutes recorded our discussions, but you said that right now our target basically was not raised from 60, but we agreed to allow it to float upwards towards 70, and you actually have achieved an actual rate of a little bit above 65%.
Yeah, that's right. That's where it is. That's right.
So right now, what is our target? Is it still 60?
It's by virtue of policy, it's 60, but the investment policy allows you a range. So you're still in bounds.
Okay. So by raising the target to 65, what would be the real effect? If we didn't raise the target before, but we allowed the allocation of equities to float upwards towards 70, and if 65 is within the range of 60, what do we achieve by raising the target to 65, allow it to float upwards with a possible potential range of 75?
Well, it's actually a good question.
Well, thank you.
Both plans.
As compared to most of them I asked you, me.
See what a lot of education gives you, a lot of insight. All three plans here have a maximum of 70. I want to just confirm that you're not at something below that. But I guess just trying to find this number in here. I'll find it in just a second. Oh yeah, you're at 70. So you have a higher, let's say a more of a range from the target to the max than the police and fire. Their target's 65, they can't go above 70. Your target's 60, can't go above 70. So a simpler way to do this, instead of rewriting, changing the policy, I think the policy works fine the way it is. We can just let it continue to move up towards 70. With
What
that,
inspires it to move up? Is it the,
Pardon?
that moves up through the contribution of the employees of the fire department or police department?
well, all I'm talking about is just the overall mix of assets. The stocks
Okay.
keep go up. Normally, when the stocks get up, let's say 2 or 3%, we cut them back, put the money back over to bonds and balance it out. What we're saying is, this is what we've never proposed here before, but my sense is we want to speed this thing up more, and we can by simply allowing us to get towards 70 and stay up near 70 for longer periods of time. I can make that call. Prior boards here have been more conservative and have tended to want to stay towards closer to 60. I say we just let it run up to 70 and just keep an eye on it. Don't let it get above 70. If it does, we'll cut it back.
As you indicated, we're also increasing the volatility.
But it's not, I would not say it's unreasonable volatility, and I would not say it's imprudent volatility, because if you canvass the state and look at, we have 100 of these plans. I mean, there are 500 or 600 of them in the state. They're all in that 65 to 70% range. So you're right in the sweet spot.
Okay. Well, so as I understand it,
I don't think you need a motion. I think as long as we're talking about it, it's in the notes, and I'm just communicating to you that you're within the policy constraints. I don't think you need to approve anything.
okay, so does the board understand that essentially what he's indicating is that our established cap under our plan is 70% equities? We have a target of 60, but we agreed at the last meeting to allow the allocation of the plan to float upwards towards the 70% number. It has floated upwards to 65%. The suggestion is that we just leave things status quo and allow the allocation to continue to float upwards towards 70, and not change the cap and not change the policy, correct?
That's right.
Hmm?
What's that?
Did I recall you asking to change it to 65?
My notes don't indicate that. Do you have any something different written down?
I have notes from the last meeting say that
From 60 to 65?
BCA will increase the percentage of assets and equities towards 70, and the results will be reviewed at the next meeting. A motion was made by McCaskill and second by Dennis for BCA to identify and move other index products into other index products that are equal in strategy.
Yeah, we did that part.
Yeah.
Yeah, that's consistent.
The motion was the index products and not the movement of up to 70, because it didn't require board action because, yes, because.
I think you're okay. We've talked about it. I'm expressing to you my strategy. Let her keep going up. We're not going to cut it back. We're just going to let it run up towards 70.
What if something happens, equities take a large hit? What, you're able to,
Well, what we have the authority to do, I believe, because consistent with past practices, is between meetings, we can issue a rebalance through Jill. In that example, the bonds would have gone up in value. And now we got to rebalance.
Yeah.
So we'll be moving bonds back over towards the equities, which obviously would be a good idea because they've gotten cheaper. We've been doing this for a long time. That's how you do it.
I'm good with what we've been discussing. It sounds like the board is on the same page, so sounds like no motion is needed, and we can just leave that topic as discussed.
Okay, thank you, Mr. Chairman. Let's go to page 22 because
excuse me, Burgess, but the
Yes, ma'am.
computer is not displaying anything. It's run out of memory and
That's how I feel at the end of the day sometimes.
Run out of memory.
yep, that's what.
Ran out of memory, huh? Gee whiz. Do you want to reboot it?
No, because then I have to restart the entire meeting.
Okay. Well,
Zoom
how many
meeting.
guests do we have? We have Cassandra.
So-
Cassandra,
They all have your
I'm,
report.
oh,
I'm reviewing my report. Yep.
okay, then may I proceed?
So all you're saying is that we don't have a display, but the meeting is still
Exactly.
is being recorded and
Yes,
the only disadvantage we have is not being able to display on the screen.
exactly.
And somebody's going to see if we can do a memory enhancement on our computer before next meeting or something of that nature.
I tell you what, she always, like superwoman, flies in here to fix everything. On page 22, we can go to our respective books and I want you to follow this. This is a 16 and a half years of experience from right to left. These are fiscal year actual returns. And what you see on the left-hand side, 1378 is the first 6 months of your fiscal year. As we speak, your numbers are closer to 18%. So God willing, we'll hit something around 18, 19% this month, which will finish your third quarter. And the last time we had anything that strong or close to it was the fiscal year 2012. It is possible that we will do better than 20% this year, and I'll tell you why. $7 trillion has been injected into the economy in the last year. This is money that's come from the Federal Reserve and Congress. This is unprecedented stimulation. This is stimulation in wartime. The COVID phenomenon was so scary that our country basically went all in on this. It was so asymmetrical. No one had any idea if we were upside down or not. And the result is that you mentioned in Mr. Bush, you mentioned people concerned about inflation. It's already affecting the producer price index, which is a precursor to the CPI. So input costs from lumber to copper to you name it, those costs have really gone up. But it takes a while for that to kind of work through all the way to the CPI level. But still, the CPI number last month was 4 something. And the 20-year average is around 2. So point is, with all this stimulation, it means that companies are going to earn more money, prices are going to go up, and the plan ought to be able to experience favorable returns this year. And this great party will continue as long as the Federal Reserve is an aggressive buyer of bonds and they keep this thing going. The Federal Reserve is going to end the party when they want to. And I don't know when they're going to do it, but when they decide to start tightening up the restrictions on banks, lending requirements, and start raising the short-term rates, then you're going to see some deceleration. But there's so much power in this expansion that it's going to continue for a couple more years. Even if they start putting the flaps out or the brakes on, you're going to see this thing expand. Real estate's going to go up. It'll continue to go up. Inflation hedges. What do we have? The best inflation hedges we have here are the equities and the REITs. The bonds are not a hedge against inflation. They're a hedge against prosperity. But we have to have the bonds because of the liquidity. What do I mean by that? If we have a 2-year protracted downturn in the market, we still have to make payments to retirees. You don't want to be spending the money that's lost money. So the first place you're going to look at are the bonds. So that's why we have the bonds. They're liquid. Okay. Have you all read this report already, more or less?
Memorized it.
There you go. I'll speed it up a little bit. Page 1. Frank in my office took this whole Bitcoin cyber thing and crystallized it down to 1 page. This is like a fine whiskey. I mean, this thing is 1 page, got it all on 1 page. This picture here, this photo, this artwork was sold for $69 million. This thing is so out of control. What can I tell you? But I believe this, because of the clandestine and nefarious activities that have been going on with crypto, with Bitcoin and the payments through the wallets, it's going to end. It'll end, and it could end sooner than later. China has already outlawed trading and owning Bitcoin. India has already done it. Those are the 2 most populous countries on the globe. Japan has already done it. US hasn't figured out what it's going to do yet, although apparently our people penetrated the bad guys who extorted that money from Colonial Pipeline and got some of it back. So that's encouraging. Something good is happening there. But because of the threat to the sovereignty of countries and their central banks, Bitcoin will have a limited lifespan. Although El Salvador just announced they're allowing Bitcoin, but I guess if you live in El Salvador, there's nothing there. So maybe Bitcoin was the default.
What do you see? You just said what you see the ultimate future of Bitcoin being, but marijuana industry is seemingly printing money right now, and we've got 2 groups that say they are locating here, putting big money into facilities. My understanding is the last time I looked into it, very few, if any, banks are allowing or accepting the product of or revenue from the marijuana operations because it's still not federally allowed. And I understood that a lot of the marijuana guys were going Bitcoin with their profits.
I would say, I know a little bit more about this because I have a client that is tasked me to, we're actually pretty deep into this. We have a client in South Florida that's investing in California. We'll just say the marijuana industry.
Okay.
And so I've already been out there. I've already met with the people who run these operations, and I was absolutely thoroughly impressed. Now, the way we're going to do it is we're investing in a company that makes loans. So these are non-bank private entities. They're not regulated by the banks, and they make direct. These are usually 24-month term loans, 15% interest rate loans. The equity side, so you've got, that's the debt side, okay? Non-bank, but it's debt. The equity side is all private equity money. They're able now to, the money doesn't have to be moved around on pallets with AR-15s anymore. It's now much more sophisticated than that. And there are companies that will actually take all that money and process it and make it so that you can actually legitimately put it in banks. So the industry has become much more legitimate. And by the way, when you look at the way they run these operations, from cultivation to co-packing to dispensing, first class. Clean rooms, everyone's in gowns with booties and hats, and extremely, and the employees are all young and smart, and they're not, walking around with their heads bobbing. I mean, these are.
They don't allow sampling of product during breaks?
No, these are young engineers. They're young, they're really young people with a lot of drive and a lot of spirit. And
So you don't think Bitcoin is going to be their salvation?
Doesn't have to be.
Okay, I just
Doesn't have
asked,
to
just
be.
asking.
I don't think it's part of the formula. I got you all. You having a, you want me to turn it down? Okay. If you look at the top of page 4, you can kind of read it yourself. But, you know, your 10-year average, it's 1, 2, 3, the fourth bullet down, net just shy of 8%. The bogey was 8. We came in darn close to the bogey. The police and fire planes are right around the same number. And FRS is at 7. Well, Patrick's not here to defend himself, so I don't really see any reason to rush into 7%. If you get a letter from the state and they start to shake you and say you need to go to 7, then maybe you can start thinking about 7. But the way this thing works now is there's a 5-year averaging smoothing mechanism to take away the year-to-year up and downs from a budget standpoint. That's why they have done this smoothing over the years. And from year to year, when they drop off one year and add the new year, hopefully this year will be better than 20%. They then redetermine what the required minimum contribution is by the city. But if the performance of the plan is not achieving the assumed rate, which is, are we at 7.5 now?
7.5.
Then there will be a gradual increase in the required contributions, gradual, because it's being smooth. If you go right to 7 now, it induces a faster pay down or acceleration of paying down the debt or paying down the unfunded liability. I don't see why it's necessary. If you're at 70% now funded and you have a good year, that number is going to bump up to 74, 75% in 1 year. And I just don't see a reason to add more money. If you add more money, it would increase if you didn't change the current assumption. If you left the current assumption at 7.5 and added a couple 100,000 more to the plan, that would bump up the funding ratio along with a good year closer to 80%. But when you dial down the assumption to 7%, you're going to pull down the funding ratio. The funding ratio will be pulled down if you lower the assumed rate of return.
Well, you're the expert, so
Well,
it's easy for us to, for me at least, if you don't see a need to rush into it, he's not finished with the study anyway, then.
you can, he's a smart guy, and you might consider proposing, if you had the money, not this year, but maybe FY 2022, contribute more than is required, but leave it at 7.5%. That'll boost the funding ratio up towards 80% faster.
Just like a principal payment on a loan.
Exactly. But you got plenty of time to think about it and kick it around. But I wouldn't be, I'll tell you, and the other reason I wouldn't be in a hurry is this. Along with these recommendations that all the actuaries are all doing the same thing, to all their clients to go to 7. They're making the point that all the so-called experts are predicting a big sell-off in the market. So you need to lower the assumed rate of return. Well, here's my question to that. Why would you want to pay more into the till now if your expectation is that you're going to lose money in the near term?
Especially if you're putting your money in equities.
Why would you do that? And since it self-corrects, I would wait. And if there is a correction in the market, add more money later on when the plan has gone down in value, not now, and lose that money. So that's the argument I've been making. But I think there's just overall pressure within the industry to lower the assumption rate, getting it back towards 7%.
I'm sorry, I'm not just checking messages. We have a severe thunderstorm warning. I just wanted to see what area of the county it was impacting.
I've got a little radar thing I'll show you in a second. If you go to page 16, I'll wrap it up. You might find this interesting. If you look under the fixed income category on page 16, you'll notice that your total for the quarter, the bond market, took a pretty good hit in the quarter. Bonds, total bonds were down 1.3. The police and fire plans were down 3.6. For the fiscal year to date, you were up 0.4 and the police and fire were down 2.3. I'm sorry, we're down 2.7. And then for the one year, you're up 4.1 and the police and fire were both up 2.3. We have a different bond strategy than they do, and it's actually done quite a bit better than their program. The reason why your numbers are close to theirs this for the rolling 1 year, even though you have a lower allocation, almost a 10% lower allocation to equities during that period, is one, while we're on this page, the REIT was up 29%. And you had a pretty good allocation there where they had a big underweight. And then if you go to the previous page, on the bottom of page 15, we had a nice heavy weighting in the convertibles, which were up 79.6% for the year. And the police and fire plans had a big underweight. So just all about asset allocation, even though we had somewhat of a disadvantage here with the equity limit self-imposed, we were able to keep the returns almost the same as the police and fire.
Vanguard
all.
Russell Fund really kicked, didn't it?
Which one, the Russell 2000?
Yes.
91.6. Of course, that's small cap. And this measurement is from the trough. Remember, the market sell-off was February through March of last year, and almost clockwork, beginning of April of last year to the beginning of April this year, 1 year, small cap had a meteoric rise. That's something, isn't it?
It is.
So that's all I have. Is there anything you want me to do between now and the next meeting?
Not me. I mean, looks like, unless I'm missing something, things are pretty stable and on the right track.
I think so. We got the expenses reduced with the funds that we migrated over the index funds and the active share classes. We got a lot done for you, and then reviewed the custody agreement. It's competitive. And that's it.
So looks like Brett, you're on the Zoom call with us now. I didn't notice that earlier.
Yes, sir. Sorry I was late.
No, that's okay. Just so you've heard most of the meeting yourself then?
I've heard about the last 15 to 20 minutes.
Okay. All right. Does anyone have any questions of Mr. Chambers? Anybody? I don't have any.
Thank you.
Thank you.
Stay dry and stay out of the lightning.
No joke. Thank you. Hard to argue with that advice.
You want to make a motion to accept his report?
Yes, ma'am. Do you?
Motion to accept the report.
So motion's been made to accept Mr. Chambers' report. Mr. Dennis, did you hear the motion?
I did. I second that.
You're thirding it actually, but that's okay.
Apologize. Yes, sir.
Any further discussion? If not, then all in favor?
Aye.
Okay, thank you. Motion's accepted or motion's passed. And with that, do I have a motion to adjourn?
No, we have budget.
I like the motion to adjourn, Jill. Why do you keep doing that to me? All right. Sorry about that. We also left Miss Harvey out of the loop. So Miss Harvey, I guess your report is next. I apologize.
That's quite all right. I will make it short and sweet. The only thing I would like to mention at today's meeting is your Form 1 financial disclosures. As you know, they must be filed by July 1st in the Supervisor of Elections office in which you reside. And that's all I have for the attorney's report.
All right. Anybody have a question about that?
If
not,
not,
thank you.
would it be all right if I signed out? I do have another meeting at 4:30.
Yes, ma'am.
Thank you very much, everybody. Stay safe.
Thank you. Again, I don't mean to be rude. I have a city commissioner texting me, so just let me respond to this.
Is it okay if Jill go ahead and
Certainly,
redo the budget for fiscal year 2022?
please.
The budget's up on screen. Everything's gone up a little bit. The schooling,
South of us?
we have 3 trustees for 1 conference. I got notification from the state that there was going to be a conference. We haven't seen it online at all yet. And actually Cassandra from the Klausner told us at the last meeting that she heard now that they're not going to be having a meeting, a conference. So we'll
Yeah, most
see
of that
what-
looks
what's
south, north
actually
of
going
us.
to happen.
So
So we're not gonna have that $3,000 that you're looking at, that was set aside for the conference, that was.
May or may not happen. But given that this starts in October and goes all the way through September, we may
Okay.
catch another one. And of course, the investment fees go up every year because the value of our portfolio goes up and they're on a basis point. So
anyone have any question about the proposed budget? Mr. Bush? Question? Mr. Bush, do you have a question?
No, I.
Mr. McCaskill?
Not
Commissioner?
at this time.
So are you asking that we adopt this budget?
yes, please.
Motion to adopt the fiscal year budget for 2022.
Motion and a second. Is there any further discussion? Mr. Dennis, did you hear the motion in the second?
Yes, sir, I did.
Any further discussion?
No, sir.
If not, all in favor, say aye. Any opposed? All right, Jill, I assume you want me to go to quarterly expenditures next? Are these in our package? Because I can't read that screen from here.
Looks like that.
Got it. So Jill, explain to me what item contribution refund for Cowan's is. It's a 596, and that's showing that's a negative.
It went out, it apparently got lost in the mail. And so we voided it. So then it had to be refunded. There have been a lot of contribution refunds you see here. They're not all from this, they're not all terminations from this fiscal year. They were delayed in the HR office for a while, so now they're getting caught up.
Alan, I don't, you have a contribution refund?
Say what now?
Is that you, Abe Bush, with a contribution refund? Huh?
Yes.
He gets money out of his
I have, that's,
drop
Gotcha.
periodically.
Okay.
Kind of, you were able to do that during COVID without any penalties? Was it due to COVID, because you can do it without any penalties, am I right?
Does anybody have any question about the expenditure report? Mr. Dennis, are you able to see this?
Yes, sir, I am.
Do you want a motion to accept this, Jill?
Yes, please.
Is anyone willing to make a motion to accept this as the report is accurate?
I'll second it.
Motion is that the report is written.
Mr. Bush seconded it in advance. Any further discussion? All in favor?
Aye.
Opposed? Okay. Do we have any public comments? Thank you.
I know I'm used to sitting over there, and this is, I'm like, why am I?
I'm having a hard time getting used to these plexiglass
Yeah.
shields in terms of the way it blocks your vision.
And the mayor kind of was asked about that at the last meeting. You're staying up.
Okay with me. I don't mean, just they do block vision. They're like when you're,
No public comment.
okay. No public comment. So any other business to come before us? Anybody? If not, can I have a motion to adjourn?
Motion adjourned.
All in favor? Thank you. All right, folks, thank you. Mr. Chambers, thank you.
Thank you so much.
Jill, note that he's